Today, we're diving into a topic that could save you thousands of dollars as a homeowner in Canada: mortgage discharge penalties. I'm Tim Hill with Dominion Lending, Primex Mortgages. Welcome to my channel. If you've ever thought about selling your home, refinancing your mortgage, or paying it off early, you need to know what these penalties are and how they work. As a mortgage broker, I've seen too many clients blindsided by hefty penalties, so I'm here to make sure you're informed. In this video, I'll explain what mortgage discharge penalties are, how they're calculated, especially the tricky interest rate differential, or IRD, and share tips on how to minimize or avoid them. Let's get started. When you sign up for a mortgage, you're entering a contract with your lender for a set term, like 5 years. If you break that contract early, say by selling your home, refinancing with another lender, or paying off your mortgage ahead of schedule, the lender charges you a penalty. This fee compensates them for the interest they would have earned if you'd stuck with the mortgage until the end of the term. These penalties can be steep, sometimes hitting thousands or even tens of thousands of dollars. So, understanding them is key before you make any big moves. Let's start with variable rate mortgages, where the penalty is pretty straightforward. Variable rate mortgages are popular because they often offer lower initial interest rates compared to fixed rate mortgages. However, understanding the penalties involved is crucial for homeowners. If you have a variable rate mortgage, the penalty is typically 3 months' worth of interest on your remaining balance. This is a standard calculation used by most lenders, making it relatively simple to understand and predict. Here's an example. Imagine you've got a $300,000 mortgage at a variable rate of 3%. This scenario is quite common among homeowners who opt for variable rates due to their flexibility and potential cost savings. To figure out 3 months' interest, take your annual rate, 3%, divide it by 12 for the monthly rate, 0.25%, then multiply by 3, 0.75%. This step-by-step approach ensures accuracy in your calculations. Apply that to your balance. 0.75% of $300,000 is $2,250. This method provides a clear and concise way to determine your penalty. So your penalty would be $2,250. Easy, right? Understanding these calculations can help you make informed decisions about your mortgage and avoid any unexpected costs. Always consult with your lender or a financial advisor to ensure you have the most accurate information. Now, fixed rate mortgages are a bit trickier. The penalty here is the greater of two amounts: 3 months interest, or the interest rate differential, or IRD. We've covered 3 months interest, but what's IRD? It's a calculation that figures out how much interest the lender loses when you break your mortgage early. It compares your current mortgage rate to the rate they could charge for a new mortgage, with a term matching the time left on your original deal. But here's the kicker. Not all lenders calculate IRD the same way, and this can mean a huge difference in what you pay. Let's break it down with an example. Understanding interest rate differential, IRD, can be quite complex, but with a clear example, it becomes much easier to grasp. Say you have a 5-year fixed mortgage at 3.5%, with 3 years left and a $400,000 balance. This is a common scenario for many homeowners who have locked in their mortgage rates for stability. If interest rates have dropped since you signed, the IRD could get pricey. This is because lenders want to recoup the interest they lose when you break your mortgage early. Some lenders calculate IRD using your contract rate, 3.5%, minus their current rate for a similar term, which might be at 2.5%. This method is straightforward, but can still lead to significant costs. While the 1% difference might not seem like much, it can add up quickly when applied to large sums of money. Multiply that by your balance and remaining term. 1% of $400,000 is $4,000 per year. times 3 years is $12,000. This calculation shows how quickly the cost can escalate, particularly early on in the term. So in that case, your IRD is $12,000. This amount can be a significant financial burden for many homeowners. If that's more than 3 months' interest, which would be around $3,500, you'd pay the higher amount, $12,000. This comparison helps you understand the potential penalty you might face. But some lenders, like the big banks, might use the posted rate from when you signed, say 5%, and compare it to the current posted rate for the remaining comparable term, perhaps 3.5%. This method can be even more costly. That's a 1.5% difference. This higher percentage difference can lead to a much larger IRD. So, 1.5% of $400,000 times 3 years is $18,000, a $6,000 from the first method. This illustrates how different calculation methods can significantly impact the amount you owe, and some even factor in the discount you got originally, making it even more complex. This additional complexity can make it difficult to predict your exact costs. The point? IRD calculations vary, and that can hit your wallet hard. It's crucial to understand how your lender calculates IRD before breaking your mortgage, so you can make an informed decision and avoid unexpected financial strain. So why does this matter? Because the way IRD is calculated can vary widely between lenders, and it directly affects your penalty. When picking a mortgage, don't just look at the interest rate. Check how the lender handles penalties too. Some non-bank lenders might use your actual contract rate instead of the higher posted rate, potentially saving you thousands if you need to break your mortgage early. What drives the size of your penalty? A few things. Remaining balance. A bigger mortgage means a bigger penalty. Interest rates. If rates drop after you sign, your interest rate differential goes up. Time left in your term. More time left means a higher IRD. Lender's method. As we've seen, their IRD formula matters a lot. Knowing these can help you estimate what you might owe. How can you dodge or shrink these penalties? It's a question many homeowners face, especially when dealing with the complexities of mortgages and home sales. Here are 5 practical tips that can help you navigate these waters more smoothly and save you money in the long run. First, time your moves. Try to sell your home or renew your mortgage when your term ends to skip penalties entirely. This can be a strategic move that aligns with your financial goals. Second, use prepayment options. Most mortgages let you pay extra each year, either through lump sums or higher monthly payments, without penalty. This not only reduces your balance, but also minimizes any future penalty. This approach can significantly cut down your overall debt. Third, consider porting your mortgage if you're moving. Some lenders allow you to transfer your mortgage to your new home without incurring penalties. Always ask your lender if this is an option for you. Fourth, pick a lender wisely. When shopping around, make sure to ask about how they calculate penalties. Some lenders have more borrower-friendly terms than others, which can make a big difference. Doing your homework can pay off in the long run. Finally, consider an open mortgage if you might need flexibility. An open mortgage lets you pay it off anytime, without penalty, but be aware that it often comes with higher interest rates. Weigh the pros and cons carefully. By following these steps, you can save a bundle and make your homeownership journey a lot smoother and more financially rewarding. Before you sign any mortgage, read the fine print, especially the prepayment penalty section. Understand how your lender calculates penalties. Not sure? Ask your broker or lender to walk you through it. Once you sign, you're locked in, so get clear up front. To sum up, mortgage discharge penalties can sting if you're not ready. Knowing how they're calculated, especially the IRD for fixed-rate mortgages, puts you in control. Lenders calculate IRD differently, so pick one that fits your plans. Thinking of breaking your mortgage? Crunch the numbers and explore ways to cut the cost. And always chat with a mortgage pro for tailored advice. Thanks for watching. If this helped, hit like, subscribe, and share it with friends. Got questions? Send me an email or drop them below. I'll see you next time.